Time to put the spotlight then on ChrysCapital Partners. It's a leading India-focused investment fund with approximately $4 billion of assets under management across their 8 funds. This includes the company having raised close to $5 billion across 9 funds with investments across sectors in companies such as HCL Technologies, Infosys, Emphasis, Hexaware, Dream Sports, and many more. Joining me on the show right now is Sanjay Kukreja. He's partner and CIO at ChrysCapital. Thank you so much, Sanjay, for taking time out and being with us on ET Now. To begin with, I just want to discuss the landscape when it comes to private equity investments, because we have seen a fall in PE deals across the globe. There's been high inflation, higher interest rates, and sentiment as a whole has been dented quite significantly. Is India mirroring the same? What's your take?
Well, I think the sentiment is a bit softer in India as well. If you look at just broad numbers, total private equity money into India was 65 billion the year prior, and last calendar year it fell to about 45 billion. But that number is still a very, very large number in the context of India, and of course in the context of global investments as well. So when we started investing in India back in 2000, total private equity money in India may have been less than $1 billion. I remember it peaking in 2008, the 7 and 8 at 17 billion, then fell all the way back to 4 billion or so. And then has built up from that 4 billion today to about 45 billion. So of course it might have cycles, it may have ups and downs, but the longer term trend has been a very secular positive trend for India. And that's a trend I think will likely to continue into the future.
All right, has been fairly secular, and hopefully that trend should continue. So in light of the fact, Sanjay, that we have seen as well globally a lot of sell-offs coming in, we're calling it the funding winter as well. Back home, there have been a few companies as well that have borne the brunt of this, but we have seen a lot of talent as well that has been absorbed by some of the homegrown companies. Is this a real worry, these recessionary concerns, the pink slips being doled out, or do you think that most of the worst is largely behind us now?
I think what we are seeing is a little bit of a time correction in India. I don't think we've seen a very sharp fall down in valuations. Unlike the rest of the world, I think US has seen a very large correction, so has Europe. India has seen a correction, but not a major sell-off. And that's partly because of the economic environment that India is in. It is the one place, which has still got sort of bright future ahead of it, younger age, demographics, money is still flowing in. Yes, growth might be slowing from a 7-8% closer to the 5-6% range in the GDP growth perspective, but it's still growing. And the more you talk to investors globally or decision makers, you see that India certainly does seem to take center stage in their mind in terms of still allocating more capital to. So we're seeing a slowdown. We're not seeing a funding winter in the Indian context.
Let's first start off, from you by understanding what the focus is in terms of the investment strategy. Very sector focused and long-term horizon, correct?
Yes, so private equity, 10-year horizon, we tend to hold our investments 5 to 7 years. So the investment horizon is large enough to sort of accommodate economic recessions, and near-term sort of fluctuations, if you will, right? Fundamentally, the story is of backing growth in India, and backing some great entrepreneurs. And we've seen some great stories and winners over time, because we've been in India now for 24 years. As you sort of recounted, lots of investments. We've just completed our 100th investment actually as a firm. And we've also seen 80 exits. So through cycles, a lot of experience, through the years. And really, if you just recall back and say, look, what is the fundamental thesis has always been backing sort of great entrepreneurs and good businesses through cycles.
Now, speaking of the IT space, there have been a lot of investments that have been identified within the space. You spoke about multiple exits, and that has happened largely within IT, Cyient, HCL, Infosys, LTI, KPIT, Emphasis. I could go on. Just walk us through, what was the strategy in identifying these companies? How long ago was it? And, how did those investments really pan out for ChrysCap?
So, so first of all, ChrysCapital has always had a sector-specific approach. I think back in 2001, 2002, right from that point onwards, we've really had a focus on organizing the firm even by sectors. So IT services was always a very strong focus area for us. And our teams are organized, the sectors were organized by that. So there was always a sector lead who was looking at IT services. I've covered it personally for many years myself, but others have too over the years. And what we were able to do with that is really lived experiences, right? Identify some of the better companies. We have had, almost a third of our capital through our, history of investments has gone into business services, the sector that you called out. And had a very, very strong successes in that, as you recounted some of the names. But even within that, the strategy has changed quite a bit. I think we've done, early stage deals like Infosys and Spectrum Mind back in the day in 2002, 2003 timeframe when these businesses were scaling up dramatically, to later stage companies in 2007, 2008 like Infosys and HCL, which were more listed in nature, and we were taking advantage of market corrections post the global financial crisis, and maybe just prior to that as well, where we came in and said, look, some of these companies can continue to scale, and we're getting good, attractive valuation points, and that's when we made some of those investments.
Can you walk us through what the outlook is here? Because it seems like a lot of the industry executives indicate that it is a bit cautiously optimistic. So what's the strategy while identifying now players within the IT space?
Yeah, so I think, look, obviously there are, IT services business is not, fully recession proof, right? You are servicing Fortune 500 customers. I think, obviously Eurozone is already in recession, US likely to, get there at some point, at least a lot of talk around that. And so corporations are actively sort of, thinking through their budgets, and in such environments, I think, if you divide the businesses into run the business and change the business, the change the business side tends to get pushed back, whereas run the business is more sort of those investments still need to be made. So you pivot a little bit more towards run the business types of companies, and because they have a little bit more surety of growth in the next 4 or 5 years. But in general, I think IT services businesses are part of the solution, not part of the problem. And as companies look to cut the costs, and make themselves more efficient and streamlined, they're doing two things. Either they're sort of making their businesses more streamlined through a recession, in which case IT services companies still form part of the solution, offering them sort of cost reduction, or they're trying to make their businesses more digital, more transformative, to take advantage of disruptive change that's happening all around that.
It seems that one sector that has been relatively unfazed, if you could, would be, the hospital space. We've seen a lot of deal flow as well that's taken place. So pharmaceuticals as well as that entire space as a whole, the healthcare services, that's a space that you as a group as well have invested in. KIMS Hospitals, Eris Life Sciences, Mankind, etc. Do you think that we are likely to see a lot more focus on healthcare, especially post the pandemic, and therefore the sector as a space looks a lot more interesting?
I mean, pharma is actually, again, one of the core sectors that we've had focus on since 2003 onwards. We've had Sanjeev join us in 2004. We used to be president at Ranbaxy before that, so a lot of operating experience, and led our pharma investments for a long time. Today, another colleague runs it. We are obviously very prolific investors, but what we've in pharma and healthcare. But what we've done more recently is actually broken up pharma and healthcare into two separate sectors, really reflecting what's really going on in the market today. There is, the domestic formulations market, which is really the pharmaceutical companies like Intas and Mankind, where we've been investors for the longest of times. These are fantastic businesses, generate very high return capital, very high gross margin, provide, also from a certainty around growth. I mean, they'll never be the companies that can grow 10x and like that, but there will always be steady Eddie growth in these companies, as they provide a critical service to India to really get Western medicine, more integrated into society, right? So they're playing that critical role, and these companies are scaling up because of that, because there's still much more legroom for growth in these businesses. So that's been our, very sort of dominant theme that we've been investing in over the last 20 years. More recently, I think we've, started investing in the healthcare delivery side, whether it's multi-specialty hospitals, but regional plays like KIMS that you talked about, or even single specialty hospital chains and all that we are looking at. We haven't yet made an investment there, but I think those are the ones that can, on the delivery of healthcare, there is sort of a lot of scope for expansion as well as sort of return on capital also being developed in these box models. So these are like you can actually see in diligence and look at a box that's really working well in one market, and then you're saying, can we expand it into contagious markets? Historically, the challenge has been that entrepreneurs have done like expanded too recklessly in that space and said, look, I'll invest in 5 or 10 different boxes at the same time, and that's why the sector historically didn't make as much money. But recently, in the last 5 and post-pandemic, I think people have just narrowed their focus and said, look, I'll get deeper into the territories that I really like. And that we're seeing is a very significant change in strategy that we're seeing on the ground, which has resulted in better economics for the healthcare delivery companies. And that's what's getting us excited about investing in healthcare delivery firms as well.
Okay, fair enough. That's the view on healthcare. But moving right on then, what's the outlook when it comes to manufacturing as a space? Because, experts seem to allude to the fact that India is seeing a manufacturing renaissance of sorts, and here is where all the action will be. Do you believe that there's a lot of potential? Can you walk us through some of the investments that have been made within manufacturing?
So, we've been, obviously manufacturing in India is something that is has always been on the come, right? And it's been a sector that we've always been looking and tracking at, but has also not been a sector that has delivered historically and has, flattered to deceive. Having said that, I think a lot of action has happened in the last 5 years, whether it's from a policy perspective, whether it's a confluence of global events, playing out in a certain way, whether it's geopolitics and cost structures moving in a different way in China, etc., which have created opportunities for Indian entrepreneurs. I think specialty chemicals is one area that I'd call out where it's quite clearly visible in the last 5 years, the kind of growth Indian companies have seen. It's a very strong sort of success case. At the same time, textiles was a great opportunity that Indian companies didn't capitalize on beyond a point. And you look at some of the companies in Vietnam and Bangladesh probably have taken a lead over Indian companies in that sense, in that space. So it's been a little bit of a mixed bag. I think clearly today there's a lot of excitement in the space. When you talk to investment bankers, they're putting a lot of effort in covering here. I think few of them have even said, look, investments in the space may go up 10x. So it's clearly an area you need to focus on. We are at ChrysCapital obviously evaluating this, constantly. And we would be very happy to see a vibrant sort of manufacturing hub sort of really emerge in India, because that will really allow for a lot more investments to come. Are we there today already where we are seeing hundreds of investable companies on the manufacturing side? The answer is no, we're not there today. But I think there is a lot of promise and potential, and we're tracking that, and we're seeing, in various subsectors. There's manufacturing also is lots of different themes within that, which are very large spaces. I would say a couple of them come to mind. This whole energy transition space from ICE to EVs is certainly one area where there's been a lot of private equity investments, whether it's in groups or new companies even, and all parts of the same, whether it's from the vehicle to the battery or all of that. There is a lot of investments that have come in and will continue to come, I think, because this whole space is going to get built. There's, we talk about specialty chemicals, building materials is another area which clearly a lot of, homes need to get built in India. And these sectors are one where the capital is also very, very good. So you see good businesses as well. There are some import substitution, export plays out of India, whether it's in precision automation, and other, manufacturing businesses. We were investors in Balkrishna Tires, for example, which was a export play out of India. So we've seen, businesses like that also create a lot of value, and various subsectors within that which will emerge are already emerging. And we look forward to a vibrant sort of manufacturing base being built out of India.
Okay, that's pretty interesting. And some of the investments that have been made in that sphere currently include LiveGuard as well as SafeX. But that aside, consumption as a space as well, you all have some investments within this space with TCNS Clothing, which is a listed company. Just walk us through whether or not you're expecting, some sort of inflationary concerns to maybe play spoil sport to this space, and what is it that you're looking at before identifying the appropriate companies within this space?
So what we love about consumer obviously is the fact that these businesses are fantastic businesses. They generate, they're sticky, they're retail, they're B2C businesses. Gross margins are very high. And as India sort of moves from the $2,000 to the $5,000 per capita income, the consumption curve changes quite dramatically. You've seen that play out in China. Some of it is playing out in Indonesia. You can see how, as people get richer, their consumption patterns move on a more predictable basis, and certain businesses then therefore, really can come into being and create great returns for investors. Having said that, I think the challenge, of course, is, growth has been patchy historically. We've not seen runaway growth in consumer relative to, let's say, manufacturing, or, clearly relative to IT or even pharma, and certainly relative to new economy. So growth has been somewhat muted. Inflation has been a concern. I think the single biggest challenge, frankly, has been overexcitement and valuations, which is why we've, not been in a place to actually deploy a large portion of the fund into consumer. We've always done and made investments, but they're not, as large as what IT or pharma has been for us, because we've struggled on, coming to terms with the valuations. That being said, I think where we are seeing today, there has been a correction in valuations in this space for a while, and the time correction that I talked about overall has been true for the consumer space as well. And so we do see secular growth here over the next decade, and there will be breakthrough businesses that will emerge, which will have a combination of growth and decent valuations. We've not really seen too much of that historically because of the reasons I just mentioned.
Okay, you're seeing secular growth for the next decade within the consumption space. And new investments as well include the likes of FirstCry, ExpressBees, Dream Sports. What really attracted you to some of these businesses? Why do they make the cut?
So I think new economies, we call these new economy businesses. This has been a fantastic space for us. I think we love the entrepreneurial energy we see in India and what some of these entrepreneurs are doing and new categories that they're creating. We've admired this for a while. I think from an investment perspective, the challenge was, of course, too much capital chasing few assets and lots of different elements of risk, right? Who's going to emerge as a leader? Lots of different people fighting for the same spaces. And what happens? Is it a winner take all? If somebody else wins, then do you actually lose all your capital, etc.? Which were reasons why we hadn't jumped in from, I would say, 2007 to 17, when this space really took off. And just to remind, ChrysCapital actually started its life back in 99, 2000, really being a VC to begin with. And we changed tracks towards private equity maybe by 2002, 3, post the first crisis. And of course, that shaped us in some ways, also seeing a lot of crash and burn of businesses in 2002 timeframe. Having said that, I think by 2017, we were very quite clear that we wanted to take less risk, but really back companies that had emerged as winners. And so our investment thesis was really, we're not going to take risk around unit economics. We're not going to take risk around who's the leader. Once we have these two questions answered, that there is category domination, so person has come across and managed to establish themselves as a leader, and the unit economics of the business is also something that we can diligence in a private equity style. We understand it may not be fully profitable across every segment of the business, but we can look it out and see, look, City X or Box X is really working and Box Y is moving in the same direction. We felt then, if those things are working in our favor, that's when we will sort of come in and, invest in these businesses. And you look at some of the businesses that we've done, they're really exactly that. They're leaders in their spaces, they're profitable businesses, and they have, fantastic growth. So I think, that's the general thesis. Of course, when you do all of this, valuations will be an issue and concern. And I think that's that's the trade-off we were willing to make.
Sanjay, I wanted to just get your thoughts as to what you think went wrong. Was it just, too much exuberance, as you said, when it came to the valuations, or investors really waking up to the realities that it's different when you're, privately listed, and then when you hit the public markets, it's a different ballgame?
I think it's a combination of both. I think, some of the pricing that we saw initially was very high from some of these companies as they went public. And then they had, a further run post going public, right? Because people were very excited about what these businesses can eventually deliver, but, and excited about whole, the profitability matrix come through. But we've seen some sort of even slowdown, even in, e-commerce this year, right? E-commerce hasn't grown 50% this year. It's grown 15-20% this year, right? Which is, slower than most people would have expected. And you come to the economy for growth. And so, that's been part of the reason. Part of the reason has also been, because growth has been slow and some of these companies have, built ahead of the curve, right? In terms of expecting larger growth, their margins have, come down as well, right? And so the path to profitability and, the big margins, promises that may have been made came short. And therefore, people have been disappointed with that. But that doesn't mean that these businesses are not successful or not scalable. I think, clearly there are some, businesses that are really, great business models. And frankly, what we're seeing is businesses actually becoming more and more omni-channel, right? It doesn't matter whether they're just, a new economy or on an app-based business, but really putting physical stores on the ground and physical businesses actually moving online. And there's a real confluence of both sides. And so I think, both businesses will look very similar, maybe, 5-10 years later, because both will have to learn and, there's a journey in both sides that I think entrepreneurs from the new economy side will have to really learn the challenges of working in the physical world and vice versa as well. And so that's a journey that needs to be crossed, and therefore valuations also sort of, merge in some ways in these businesses. But having said that, I think long term, these business models are very, very good, and some really good companies are definitely emerging here. And we feel like, for us in Fund 8, almost 25% of the fund actually is in new economy. And so we've taken a significant exposure here. And as we look to invest Fund 9, which is the latest fund, I wouldn't be surprised if we end up doing 15-20% of the fund again in the economy, because we're seeing some very good businesses scale.
Time for a quick break. Do remember to connect with us on SEC at etnow.tv. Take a look at the tweet of the day.